Hi, in this video we will be practicing how to record adjusting journal entries, but before we begin I'd like to ask you to please watch the Chapter 4 concept overview video or read Chapter 4 before watching this video. It will greatly improve your understanding. I would also like to review some concepts related to the accrual basis of accounting before we try the problem. The accrual basis of accounting, which you've been learning, is based on the revenue recognition and expense recognition principles. The revenue recognition principle states that we should record revenue when the performance obligation is satisfied, which means when goods or services are delivered, regardless of whether you received payment or not. The expense recognition principle states that we should record expenses when we receive the benefit of the cost. We call that incurring the expense. We try to match the expense against the revenue that it helped to create. Again, it doesn't matter when the cash is paid. The expense is recorded when you receive the benefit of the cost. Adjustments are necessary at the end of the accounting period before you prepare your financial statements to make sure that revenues and expenses are reported in the correct accounting period and that assets and liabilities are reported at their correct amounts. There are two types of adjustments: deferrals and accruals. The first problem we're working on deals with deferrals. Deferrals occur when cash is received or paid too early, before the revenue has been earned or expense has been incurred. For example, airlines are paid before the flight occurs, before the revenue is earned. And a business may have to pay for property insurance before they receive the benefit of the cost. The problem in both these situations is that the cash doesn't correspond with the revenue being earned or expense incurred. In these cases, we have to delay or defer recording a revenue or expense. We record the cash received or paid, but we can't record a revenue or expense. We must delay or defer recording the revenue or expense. Instead, when you get paid before you earn the revenue, you debit cash, but you credit deferred revenue, a liability which indicates that you owe your customer the good or service. When you pay for something that you receive the benefit before you receive the benefit of the cost, you credit cash and you debit a prepaid account, an asset, which means you have the right to receive a future benefit. Then later, when the revenue has been earned or expense incurred, we do an adjusting entry, moving the amount out of the deferred account and into a regular revenue or expense. So let's begin our problem. It says, for each of the following independent situations, prepare journal entries to record the initial transaction on September 30th and the adjustment required on October 31st. In A, Hockey Helpers paid $4,000 in cash on September 30th to rent an arena for the months of October and November. Okay, so let's record that on September 30th. Cash is an asset on the left side of the accounting equation, so we would debit or left side cash to increase. But since we want to decrease, we're going to do the opposite. We're going to credit cash for $4,000. And what will we debit? We can't call it an expense because we haven't received the benefit of the cost. We haven't occupied the arena for October and November yet. We have the right to, so we'll debit a future benefit, an asset called prepaid rent. There we go. For $4,000. And we'll debit an asset to increase it because assets are on the left side of the equation. We debit to increase. Now it's October 31st. Same situation. Hockey Helpers paid $4,000 for 2 months. But they've used up the month of October. So $4,000 divided by 2 is $2,000 per month. $2,000 for October, $2,000 for November. We haven't used up November yet, but we have used up October, so we need to decrease that asset account. So let's credit prepaid rent to reduce it for 1 month's worth. We want to take 1 month's worth out of the asset. It's no longer an asset. We've used it up. It's become an expense. So we'll debit rent expense for $2,000. 1 month remains in the prepaid account, and that corresponds to the month of November. In our next journal entry, we're back to September 30th. It states that we should record the receipt by Superstage Shows of $16,000 on September 30th for seasons tickets that admit patrons to a theater event that will be held twice, on October 31st and November 30th. So on September 30th, we are receiving cash. So we'll debit the cash account. Assets are on the left side of the equation, so we left side or debit to increase them. However, we have not held the shows yet. We can't record any revenue. We have not completed the performance obligation. We have not delivered the shows. So we need to delay or defer recording the revenue. So we will call this deferred revenue. Deferred revenue is not actually a revenue. It's a liability. It means we owe our customers the shows. We have an obligation to deliver them. So we'll debit cash and credit deferred revenue for $16,000 on September 30th when we receive the money. Now let's go to October 31st. At this point, one show has been held. It says to record the October 31st adjusting entry for the September 30th receipt of $16,000 for season tickets that admit patrons to a theater event held twice, once on October 31st. So the October 31st event has been delivered. We have earned revenue for the October 31st show. If we receive $16,000 for 2 events, that means $8,000 each, right? Because 16,000 divided by 2 is 8,000. So let's reduce the liability, deferred revenue, by debiting for 8,000. And what will we credit? Well, we have earned the revenue because we've delivered the show. So we can credit service revenue. Next transaction. Record the payment by Risky Ventures of $3,000 on September 30th for insurance coverage for the months of October, November, and December. So we're back to September 30th. They are paying for insurance before they receive the benefit of the cost for those 3 months. So let's do the cash part first. Sometimes that's easier. Let's credit cash to reduce it for $3,000. Since we have a future benefit of insurance coverage, we will debit an asset account. Remember, assets provide a future benefit. The asset that we'll debit is prepaid insurance for the full $3,000. Now it's October 31st, and they want us to record the October 31st adjusting entry for the September 30th payment of cash for $3,000. And that insurance coverage was for 3 months. So if we pay $3,000 for 3 months on September 30th, to find out 1 month's coverage, we divide 3,000 divided by 3 is 1,000 per month. So since we've used up the month of October now, because it's October 31st, we need to take 1 month's worth out of prepaid insurance because we've used it up. To reduce an asset, we credit. So we will credit prepaid insurance for 1,000, 1 month's worth. And this will become insurance expense because we receive the benefit of the cost, the benefit of insurance coverage for 1 month. That means 2 months remain in the prepaid insurance account after we've removed the 1 month worth of insurance coverage. Now let's look at all the journal entries. Note that the adjusting entry on October 31st, in each case, reduces an asset or liability account used in the first entry, the one on September 30th. Deferral adjustments reduce the prepaid or deferred account recorded in the original entry, and they increase either a revenue or an expense. Okay, now on to our next problem, which deals with accrual entries. Let's begin by talking about what an accrual is. Adjusting journal entries are required to record accruals because these are revenues and expenses that have not been recorded yet at all. We use a fancy word, accrual, because they are occurring at the end of the accounting period, but these are the same as entries you've already learned in Chapter 3. For example, when you've delivered a good or service and have earned revenue, but are not yet getting paid, you would debit accounts receivable to record the fact that money is owed to you, and you would increase the revenue account. We are going to be doing the same type of thing. So let's read the transaction for A. Record the receipt of a $600 utility bill for usage in July to be paid in August. Now in our situation, it says for each of the following transactions for New Idea Corporation, prepare the adjusting journal entries required on July 31st. So we are in the month of July, at the end of it, on July 31st, and we receive a utility bill for electricity usage in July. So since we've received the benefit of that electricity, we need to debit utility expense for this month to make sure it gets recorded in July. However, we're not going to be paying for it until the month of August. So we will credit a payable, which indicates that we have to pay it in the future. We owe this money. It's a liability account. So we'll debit an expense and credit a liability. We want July's electricity to appear in July, and we want to show that we owe that money by crediting a payable. In transaction B, it says to record the wages owed to 10 employees who worked for 3 days at $100 each per day at the end of July. The company will pay employees at the end of the first week in August. For our second journal entry, what we're going to do is multiply 10 employees times 3 days times $100 a day and get $3,000 that we owe them as of July 31st. So why can't we just wait to record their wages when we pay them next time? We can't, because if these are the last 3 days of the month of July, they need to get recorded in July rather than in August. So let's debit salaries and wages expense to make sure that those 3 days get recorded in July because we receive the benefit of their labor in July. But since we're not going to pay them in July, we'll put it into a payable, a liability, indicating that we owe that money. And finally, in transaction C, we're asked to, we need to record the loan money on, this is actually worded incorrectly. Let's scroll up. On July 1st, loaned money to an employee who agreed to repay the loan in 1 year, along with $1,200 for 1 full year's worth of interest. No interest has been recorded yet. What they want us to do is record the interest that's due to us, because we've earned it for the month of July, so we need to record the revenue earned in July. In this case, since we're not receiving it until the loan is due, we're going to debit a receivable. To figure out the amount, we take $1,200 for a full year and divide by 12, and that would be $100 a month. Since we've earned it, we can credit interest revenue. For short-term loans, both interest and principal are paid at the same time. So this is an accrual of a revenue. Now let's look at all the journal entries together. And here we are, a debit to an expense or a credit to a revenue.